Hey everyone, and welcome back to Ticker Shock, your go-to for breaking down the market moves that matter. Did Keurig Dr Pepper just make the biggest blunder of the year? Or is this audacious move a masterclass in strategic restructuring? Stick around to find out. Alright, let's dive right into the bombshell news hitting Keurig Dr Pepper, or KDP. The company announced a massive, and I mean massive, plan to acquire JDE Peet's for roughly $18.4 billion. But that's not all. They're also planning to split into two separate, independent, publicly traded companies. Think one focused purely on coffee, and another on their broader beverage portfolio. This effectively unwinds the merger that created KDP in the first place. Now, the market's reaction? It was swift and brutal. KDP stock plunged over 11% in a single day. Investors are clearly spooked by the hefty 33% premium paid for JDE Peet's and the company's ongoing struggles in its coffee segment. While the stock was up slightly year-to-date before this, it's now trading well below its 52-week high. So, who exactly is Keurig Dr Pepper? Founded in 1981 and headquartered in Massachusetts, KDP is a major player in the beverage industry, operating across the U.S. and internationally. They're organized into a few key segments. First, there's coffee systems, which includes all your favorite K-Cup pods and brewers, plus specialty coffee. Then you have packaged beverages, handling their branded packaged drinks and contract manufacturing. Beverage concentrates is a huge one, boasting brands like Dr Pepper, Canada Dry, Snapple, and Bai. Finally, Latin America Beverages covers carbonated mineral water and soft drinks in that region. Looking at the financials, KDP's revenue for the fiscal year ending December 2024 was $15.35 billion, a nice 3.62% increase from the prior year. Their dominant revenue stream is liquid refreshment beverages, or LRB, bringing in $10.57 billion, or a whopping 68.83% of total revenue, and showing healthy growth. K-Cup pods are their second largest, generating $3.61 billion, though they saw a slight dip of 1.90%. Appliances are a smaller piece at $772 million, and other net sales are $399 million, both also down year over year. Geographically, the United States is their stronghold, accounting for $13.37 billion of revenue, with international contributing $1.98 billion. Now, let's talk about how this massive acquisition and split impacts KDP's bottom line, specifically their earnings per share, or EPS. This news directly hits their coffee business, which, through K-Cup pods, represents about 23.54% of their revenue. We also need to consider the packaged beverage side, which, combined with LRB and other net sales that will form the new Beverage Co., makes up the bulk of their business. The news indicates that the coffee segment, specifically U.S. coffee, saw a slight 0.2% sales slip. While the U.S. refreshment beverages segment is booming with 10.5% growth, the overall coffee picture presents challenges. Considering the acquisition premium, potential integration costs, and the slight weakness in coffee, we're estimating a negative revenue impact. So, how do we get to that EPS number? First, we're looking at the impact on their coffee-related segments. Let's estimate a roughly 5% revenue decline for K-Cup pods, which brings in $3.61 billion, so that's a $0.18 billion hit. We'll also factor in a 2% impact on a portion of their packaged beverages and other sales, let's say $2 billion, for a $0.04 billion hit. That's an overall revenue decline of about 1.43% across the company. Now, here's the key part: operating leverage. We're using a multiplier of 1.9. That means for every 1% change in revenue, earnings change by 1.9%. So that 1.43% revenue hit multiplied by 1.9 gets us to a nearly 2.72% hit to operating income. KDP's operating margin is around 22.51%. With $15.35 billion in revenue, that's about $3.46 billion in operating income. A 2.72% hit there is roughly a $94 million decrease in operating income. If we assume around 1 billion shares outstanding, this translates to about a 9-cent impact on EPS, but in the negative direction. We're looking at a few scenarios here: a 15% chance of no significant impact, a 65% probability of this moderate negative impact of about 9 cents per share, and a 20% chance of a much larger 18-cent hit. Now, let's look at the market's reaction. As you can see, right after the news broke around August 25th, KDP stock absolutely cratered. It dropped over 11% in one day, erasing its year-to-date gains and hitting a 5-month low. This shows the market is seriously concerned about the short-term financial implications of this massive deal. So, is this good, bad, or neutral news? Based on the immediate market reaction, the premium paid, and the company's own coffee segment headwinds, this is undeniably bad news for Keurig Dr Pepper stock in the short to medium term. My take? I'm going to hold on KDP right now. While the immediate outlook is challenging, the strategy of splitting into two focused companies could be a long-term winner. The key will be execution, managing the increased debt, and how the market perceives the value of these two new entities once they're separate. I want to see how the integration plays out before making a buy or sell decision. That's all for this Ticker Shock. If you found this breakdown helpful, give us a like and subscribe for more. Remember, this is for educational purposes only and not financial advice. Invest wisely.